Good afternoon, ladies and gentlemen, and welcome to the Gresham House Energy Storage Fund PLC Interim Results Investor Presentation. Throughout today's recorded meeting, attendees will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. Before we begin, we would like to submit the following poll, and I'm sure the company will be most grateful for your participation this afternoon. I'd now like to hand over to the presenting team. Ben, James, good afternoon.
Thank you very much. Good afternoon, everybody. Look forward to taking you through our interim results. Hopefully, some or most of you have had a chance to see our actual announcements in terms of the RNS and the interim report and accounts. Just jumping to the first relevant slide. Great. So on this sort of set of tiles, we've got some of the key facts around the half-year results. The NAV per share at the half-year stage was 107.71p, which drifted down 1.5% over the first half, and actually all of that move occurred in the second quarter, driven by a further reduction in third-party revenue forecasts. We'll touch on that in a moment. Then we've got to the right of that a look at our revenues. They've grown very significantly year over year, primarily driven by a recovery in revenue rates, which were very weak in the first half of 2024, and that had a levered effect on our EBITDA, which you can see has almost doubled in the first half. Another driving factor was an increase in capacity, both augmentations and new megawatts, new connected power, but primarily it was driven by a recovery in revenue rates, of course. And as you'll see from our commentary, we do expect a further recovery in that area as we see skip rates, or the utilization of batteries to improve and the skip rates to come down. Going to the next line down, delighted to say that we've now reached the 1 gigawatt level, and we've completed the construction of all our historical projects and increased the average duration of our project portfolio to 1.6 hours. Moving to the right again, the balance sheet at the mid-year stage was not very different to the end of year, with cash flow largely paying for incremental construction payments of the historical construction program. However, going forwards, there will be further drawings on debt and spending of cash to pay for historical construction. And as you may know, the historical facility prior to the refinancing, which we'll also touch on, was £175 million, and the assumption was that we would draw all of that. So in the background, that reality remains the same, even though we've upsized the facility to 220 million for the three-year program ambitions, which we'll speak to as well. In terms of the focus over the last 12 months, it's been one to de-risk the business. We never expected that the merchant environment would become as volatile as it did to the downside in the first half of last year. We reacted to that by thinking about what was possible. Unfortunately, and somewhat ironically, I suppose, the industry in terms of counterparties were willing to guarantee revenue levels either as full tolls or as guaranteed floor levels, and we've taken advantage of that to copper bottom, if you will, the revenue level across the existing fleet, and also the intended new pipeline as well, which we've largely contracted ahead of constructing those projects. And this has also led to a reduction in cost of capital, which we'll also touch on. So you'll see an increase from the current level of 566 all the way up to over 900, or the equivalent of 88% of our fleet in due course, and 100% of our new pipeline will also be contracted at a floor level. So onto the three-year plan. Really what I've just gone through is a lot of the background. So the first few bullets here overlap with that. We've built out our historical capacity. That included some augmentations, which give us a lot of practical experience in terms of how to extract more value from our projects to take advantage of the longer trading periods that are available as the supply of renewables increases on the grid. We've concluded our refinancing on the back of our contracted revenues, and now we've kicked off the first step of our 3-year plan, which is to carry out the augmentations that we have planned in initial phase, and to start the construction. And we haven't kicked off the construction, but we aim to start the construction at the very end of this year, having concluded something called the Gate 2 or Q reform process, which we can take questions on, but that's a sort of a regulatory process and a full review of all the pipeline available in GB across all asset classes, and also the conclusion of the necessary putting in place of the additional funding that we need to build the projects, and that's underway now. Of course, one of the big milestones for us at this stage was to reinstate our capital allocation policy and our dividend, and we'll go through that in detail. But just suffice to say that in the near term, the focus is on the 3-year plan, on building out the new capacity, and we've set the dividend at a low level to ensure that we can fully cover the dividend at all times while also meeting these very significant growth requirements. And then from 27 and 28 onwards, on completion of the augmentations in 26 and construction in 27, potentially early 28, we'll see a significant expansion of cash flow as a function of increased capacity and significantly reduced spending on construction. And then for reference, we have seen over the last 6 months, two transactions, one within our portfolio where we've raised capital at the carrying value equivalent to our NAV in the Glastonbury project to build out a significant extension to over 2 hours. And of course, we saw our peer Harmony be taken out at their NAV as well, which hopefully provides some confidence around the value of this business. In terms of capital allocation, and more specifically, you can break it down, and the dividend policy, you can break this down into growth and income. We've always called ourselves an income and growth company. Of course, right now it's much more skewed to the growth. There is only one energy transition. There is a significant opportunity today to build out the portfolio and to take advantage of other factors coming to the fore, such as the ability to contract revenues, therefore to reduce the cost of financing thanks to those floors, and the reality that battery prices are low in a historical context, and returns are at a high. So over the next 2 years, we will be focusing on the 3-year plan. Today, we're really talking about a significant subset of that. To recap, the 3-year plan was all about augmenting projects to get good cash-on-cash returns and carry out increases in value to the projects that we have in place today in a relatively quick fashion, because there's no new connection required, to then build a new pipeline out. At the time, we said it was 680 megawatts, 694 is the current number, but it's very similar. And then a third prong to the 3-year plan, which we don't discuss today, but we do promise to, is the alternative revenue strategy, to find additional ways to capture revenues, which are not at all reflected in the third-party curves at this time. So the target portfolio, once we've done this significant subset of the plan, is to get to 1.8 gigawatts 2-hour portfolio, up from 1.6 hour portfolio. And despite all this growth, the debt to NAV will remain within the investment policy limits of 50%. And we find that this is in line, or actually lower than what we see elsewhere in the market, where typically the debt to GAV is the 50% limit, which translates into a substantially higher number when expressed in debt to NAV terms. So moving forward to the right-hand side of this page, the income side of this is, first we have reinstated dividends at a low level, assuming, obviously deducting the numbers that we know will invest into new pipeline and into augmentations, but also assuming a relatively conservative revenue level should the environment remain volatile. And so that's why we've instated a very low dividend. It's possible that revenues and cash flows are higher, but there's no commitment to this stage to pay a higher level. But if more cash flow is generated, then we will communicate or the board will communicate what will be done with this. Then from 2027 onwards, as new capacity becomes operational, and dare I say, so most of the augmentation, all of the augmentations will be completed by next year, at the end of next year, with the majority completed in the first half. Then 2027, we complete the construction of most of our new pipeline. And then once that's concluded, as I mentioned, we'll get to a 1.8 gigawatt portfolio. Now, we felt it sort of important to try and help investors run some numbers. So in a scenario where the 1.8 gigawatt portfolio is generating merchant revenues of £75,000 per megawatt per year, which is roughly today's levels for 2-hour assets. And also, in addition to that, we will have capacity market revenues. When you combine those, deduct the operating costs, all of the debt service, interest and principal, all of the PLC costs, management fee, board costs, other legal costs, administration, audit, etc. We assume, or we come out with a greater than 10p per share excess cash flow figure, which a portion of which, potentially all, potentially very little, the board will assess at the end of 2026 exactly what it would like to do in terms of next steps. But there will be the potential for a much higher dividend from 2027 onwards, and then 2028 as all assets construction is completed. Just to highlight that the curves today say that we should be at near a 90k, upwards of 90k. That would add, if it was 90k, because this is all just effectively pricing, there's no additional cost associated with that. That would add, for example, 5p per share to this figure. If we execute on alternative revenue and so on, that's an additional lever which we'll speak to in due course. So we do believe that we can drive significant value, and this is why we have carried out this plan. There's a lot of value to create here, appreciating, of course, that it does mean that the dividend, at least in terms of the formal dividend announcement, is a small dividend for a couple of more years. And then, of course, from excess free cash flow, we're conscious that the discount to NAV is substantial, and any excess free cash flow will be considered for share repurchases, but we haven't highlighted the exact amount at this stage. I'm going to hand over to my colleague James, my assistant fund manager, to take you through this page and the following one as well.
Hi everyone. Yeah, so on NAV, it's easy to see what the largest impact on the NAV over the period was. It was due to the revenue curves, and that's despite a positive backdrop of almost doubling of our EBITDA, improving significantly on our revenues and improving the underlying revenue rate. And that revenue has been outperforming the 2025 curve levels year to date. So it's disappointing to see that the largest impact comes from a further downgrade of revenue curves, but I will touch on them in more detail on the next slide. But just to point out, that's the largest bar in the middle, and that downgrade in the revenue forecast offsets some of the positive aspects we've added. So the value additions through building out new projects. So the construction's moving towards operational. We're now at over 1 gigawatt of operational projects. That's reflected in the NAV here, with some small premiums still on discount rates for a couple of assets that commissioned just shortly after the period end. So there'll be a little bit more value unwinding on those ones. Improvements on construction costs, and also extension of life across the assets, as we've got lease extensions on a number of assets. We hold the freehold for some assets as well, and we've signed new lease extension agreements as well on projects during the period. So that 3.7p shown on the bar there is as a result of moving assets, asset lives longer. We use a 30-year cap in the valuation, so despite some assets having longer lives than that, we've still capped it at 30 years for the valuation policy. So that's the bulk of the changes. On the right hand side, we kind of see the cash flow impacts from performance in the period and covering all of the costs. On the next slide is the curves. So this is the largest impact on the NAV. It's often helpful to break it down into two parts: the near term through to 2029, and then long term 2030 onwards. In the short term through to 2029, what we've seen over recent quarters, including 3 periods of last year, was a slowdown in the improvement during that period. That first section reflects some of the inefficiencies we're seeing in the market as well, often referred to as skip rate. At the moment, it's pointing toward 2029 to get back to long-term revenue assumptions and a sense of efficiency in the market and how assets are dispatched. That is somewhat in contrast with the progress we're seeing through NESO at the moment. We're expecting over the next 6 to 12 months significant improvements in the dispatch of batteries in the balancing mechanism, GC0166 being one of them, pointed towards the duration elements of a battery being fully allocated rather than just the 30-minute rule that's in place at the moment. So we're hopeful we should see some of that longer term level come through sooner. We should see that hopefully in the next few quarters of curves as that starts to get demonstrated. But if we start in 2025, we've been outperforming the curve levels during 2025. We've also talked about the 10 pence per share level once all assets are online, and we've used the 2028 as a comparison because that should be when all assets are up and running. If you look at the 2-hour level, that's just above £90,000. In the workings for 10p, as Ben pointed out earlier, we've assumed £75,000. So there is some uplift that we're still anticipating, but we've assumed the levels today for 2-hour assets of around £75,000 for those cash flow assumptions. So the projections of the scenarios we've run are pointing out where the portfolio gets to with the increased scale just at the £75,000 today revenue levels. It's also worth highlighting from the previous page that the NAV is reflecting the portfolio as at the 30th of June. There's a number of elements post-period end which should add some value to the portfolio. One of them is in the floor arrangements. Whilst we don't anticipate a significant change in valuations as a result of that, that will be coming in future quarters. On top of that, now we've got the debt in place. We have the financing for a further 350 megawatt hours of augmentations. Those augmentations will be able to go through in the next quarter as we now have the funding for them, which will bring further value to the NAV as well. And then longer term, we've got the 694 megawatts of pipeline, which again is not in the valuations as at the 30th of June. Once we have funding in place for those and we start construction, there's additional value in creating the assets and over time moving them to being operational assets as well. That's a short summary on NAV, but we can answer further questions if you have any, and I'll hand back to Ben on the debt arrangements.
Thanks, James. So, we're in the right place. Sorry, I jumped forward at the same time as you. Apologies. So on debt arrangements, we've concluded the first key step to be able to kick off augmentations. This was concluded in mid-August. We've upsized the overall level of debt from, in terms of drawable debt or usable debt, from 175 as at the level that we were at as amended as of the end of last year, or even before closing, to 220 million, and got other ancillary facilities in place as well. The fact that we've contracted our revenues helped reduce our pricing of the debt from 300 basis point spread to 225 basis points, which is a material saving. And the contracted cash flows, so all revenues less all costs, provide full coverage of the debt service with principal and interest over the debt tenor. So we've upsized the facility by 45 million. This effectively funds the augmentations and provides some funding for what we would call the junior piece, the equity required for the new projects, for which we're seeking new financing. And so in terms of new financing, we're looking to secure the full funding for the 694 megawatts of pipeline assets. We haven't just kicked this off, we kicked this off earlier in the year, which is why we think it's realistic to close this in the second half. We have an advanced term sheet, group of lenders, and all various other necessary pieces to progress this in a timely fashion over the next couple of months. Of the 5 projects that we've got as pipeline assets, we've contracted 4 of them. in terms of floor contracts. We will, of course, contract all of them in due course. Each project will be in its own special purpose vehicle or company with its own debt facility. So each one will sit underneath its own holding company. Each of those holding companies will sit underneath the main holding company that sits under the PLC, and effectively be siloed and not cross-collateralized with other debt facilities, whether it's the operational debt facility or the other new facilities we're putting in place for each of the projects. So as de-risked and diversified a picture as we can create going forward. As I mentioned, we're looking to secure this by the end of the year, and to reiterate the comments I made earlier, we are going to keep the debt to NAV levels below the 50% investment policy limit. So moving forward and touching on the sort of macro background or industry background at the moment, the most important thing that we need is to see the utilization of batteries improve massively. There are now 6 gigawatts of batteries on the system. They're still very poorly used. This chart shows the improvement that we've seen from the beginning of January 24. But it's not a significant improvement. The y-axis only runs from 78% to 98%. It would be much milder if it ran from 0 to 96%. But as you can see, it has a material impact on revenues, and so we can assess or estimate how much of an improvement there'd be if we got down to 50% or closer to 0 in due course. So, but they have plateaued for the time being. But some of the key pieces that need to fall into place to reduce them further are close, as James mentioned as well. So Ofgem are due to announce a rule or requirement called GC0166, that's the code name for it, that requires BESS and other storage assets that are finite in duration, so they can only run for a limited amount of time, to communicate the amount of energy they have in them and how long they can run, so that they can actually be used at the level that they have, rather than the estimate now that's assessed in the control room of just 30 minutes. This sees batteries basically not reserved in advance, which means that other assets are reserved in advance, like gas, like interconnectors. And once they're reserved, they are then prioritized in the control room. And that means that batteries only see a tail amount of reserve, of balancing actions in the control room. And this is what's driving the distortions that have been reported in the press, where you see wind being curtailed instead of being stored in batteries as much as they could be, and gas being used to fill in troughs in renewable generation rather than turning on the batteries, which is costing upwards of £1 billion this year, already in the year to date when you combine wind and gas balancing costs. So this is a must change that must come soon. It will be announced, we're assured, this month or next, most likely next month now, given the 29th. But it's expected very soon from Ofgem. They've said this openly, and the technical implementation of that will take a few months thereafter. But then there will be very few excuses to not use batteries. So that's a regulatory requirement that's coming through. There's a systems requirement, which is that over the next couple of months, we'll see what was called the Open Balancing Platform fully launched, and that means that all human aspects of trading of batteries and gas assets and interconnects and so on in the balancing mechanism should become automated. Now, we should expect a running in period here, but this is a major change where effectively the balancing mechanism becomes the OBP. We see a complete change from a human-led system to an algorithmically led system, and we expect this to also drive an improvement in skip rates, especially once the state of charge aspects mentioned first come into play. James, I'll pass back to you for this slide.
Sure, thank you. So there's two key elements to pick out from the chart. One is the perceived change in capacity market, and I'll explain why perceived in a second. And then the other is the change in the dynamic when it comes to trading. So to cover off the first point, capacity market. So it looks as though it's dropped significantly. What's happening here is that's a fixed contracted revenue source, often lasting 15 years. There's some 1-year contracts in between, so it tweaks slightly year on year, but broadly it's fixed. The reason for the decline is because revenues are up almost 80% year on year. So capacity market as a result shrinks. So then the rest of it kind of points to the trading picture. So Ben showed in the last slide the change in the skip rate from 2024 to 2025. We're seeing some of that flow through in terms of improvements in the trading side of things. But tolling at the moment, it shows as 24%. Tolling can effectively be considered as trading. So the tolling provider is trading these assets in the background. So longer term, with those contracts roll off, you can expect that to move into the trading bucket, which then implies it's more than half of the revenue source at the moment. And we expect that to continue. How that evolves with, for example, floor contracts coming in place is your floor will just provide an initial buffer, taking out from the frequency and trading. So the asset will be traded as they were before, picking between trading sources and frequency response, and a portion of that will be guaranteed through the floor contract. So the approach to trading these batteries will remain broadly the same. We should hopefully see an improvement in the trading side of things as the skip rate issue starts to resolve itself as well. And then the next slide will show you kind of the changing revenue picture, which I'm sure Ben will talk to now, and how that's evolved through that change in revenue split.
Thanks, James. So this slide, if you focus on the wide light blue line, that's the absolute revenue generated by this portfolio since the beginning of 2020 on a monthly basis. So it's the absolute levels, and we can see that. And the range, by the way, is the dotted red line at the bottom, which is just £30,000 per megawatt per year, and the top edge is the 210,000 pounds, and the mid green line is 120,000. So you get an idea of the range of revenue rates that we've earned on an annualized basis over the life of this fund, and we can see that the impact of the frequency response market commoditizing, and then the revealing of the skip rate issue in 2023, causing the issues that we've been going through over the last year. But we have seen an improvement from the lows, and of course, as we increase capacity, the overall revenue rates in absolute terms goes up as well. We still got some of the benefits to come through. So while we've announced the commissioning of assets, there's still a ramping up of some of the generation, and of course some of it happened after this time window in terms of being announced in August. So we've got an underlying benefit coming from newly installed capacity driving up revenues, and we've also started to see the beginning of the improved seasonality of revenues as we usually see at this time of year. So from January to July of this year is not a trend. It's a seasonal profile that we've seen, and we've seen a recovery in revenues through September. So if we were to stand back and zoom out and look at what we're aiming to do with a 3-year plan, the bars would rise further over the next couple of years to 1.8 or 1,800 megawatts, which is a little bit low, 1,766 to be exact from memory. And we like to think that the reduction of skip rates and alternative revenues will move the light blue line to somewhere higher in the range that's historically been achieved, and certainly higher than where it is now. So those are the combination of upside drivers to absolute revenues, so more capacity and better revenue rates. On this page, you have the current portfolio, and in terms of incremental information, even though a lot of this has been disclosed, is the exclusive pipeline that Grid has. In the middle of this page, you have the target new portfolio: Cockenzie, Monet's Garden, Lister Drive, LM2, and Ocker Hill. All of them are fully permitted. However, like all projects in the country, They're going through this Q reform process, which was kicked off by DESNZ, which is the Department for Energy, and implemented by NESO themselves. This is not a fast process, and it's taking longer than expected, but we do expect that the projects on this list here, given that they're earlier connections and projects way out in the 2030s and even 2040s, and they've been promised to have their connection offers come back first, and we don't expect any changes, but we do need to wait for it just in case there's anything that shows up. So that's one barrier, that's regulatory, but we expect this to happen in the second half, and in parallel we'll be concluding our financing and look forward to starting construction of our new projects, which on average are much larger than our previous ones. We're adding about 65% to our portfolio with just 5 projects, while our historical portfolio has almost 30 projects. And just on this slide here, we've continued to lead in the market. We have adding the additional projects that have gone online this year so far. We're now at 1,072 megawatts, which puts us ahead of our competition by a factor of 2 or more. New projects are being built in the same way that we're building significant additional pipeline. New projects will be built here as well, and we will see some pipeline go online from different members from this group and a couple of others as well over the next couple of years. So we do expect the competitive landscape to change a bit, but we'll aim to remain on the lead as well. And just to conclude, so three key topics to focus on, or to recap on. We've really focused on the 3-year plan. As promised, we have kicked it off. We've concluded all the historical construction. We've concluded the contracting, the refinancing. A huge gratitude to the team, wide team, because it's been a lot of work. A lot of technical work going on, design of projects, and then the construction of these projects, which are now kicked off on the augmentation side. A lot of engineering work also going on the new projects, which are large in scale, and also on the funding and so on. So we expect to get those under construction and continue to execute against the 3-year plan. Conscious that this is not the whole 3-year plan that we're reporting on today. There will be more to report on, especially on alternative revenues. Then we've got the evolving regulatory environment, which we do see as positive. The growing pains associated with Gate 2 and Q reform are not without, it can't be ignored, but they are for a good reason. And then the support for and the technical upgrades and the amount of money and people involved in implementing GC 166, the open balancing platform and so on, suggests that there's a considerable support for the proper trading of the control room. But these are still promises, and we need to see these come through. We do need some targets from NESO to help us guide our own investors. But government support remains very strong for the sector. And then finally, and not least, we've given now some clarity, I hope, on the dividend policy for the next 2 years and beyond, and the strong outlook for cash flow based on a scenario that is just one scenario of many potential ones, but hopefully at the conservative end of what's possible. So with that, I'll conclude and move to questions.
That's great, Ben. Let me just jump in, just to give you a few seconds just to look at those questions that have come in from investors. Thank you, everybody, for your engagement this afternoon. But just while Ben and James take a couple of moments to look at your questions, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Ben, James, as you can see, you've had a number of questions from investors throughout today's presentation. Thank you once again to everybody for your engagement. If I may, just hand back to you, Ben, to take us through the Q&A, and I'll pick up from you at the end.
Yeah, there's not a huge amount of questions, but there are absolutely. One that seems to recur is, sorry, just reading another one while I was reading that, is on the discount. So we shouldn't avoid that. What steps is the company and the board taking to reduce the discount? If I was to try and channel the board's thoughts, and in particular our chairs, I think that there's strong belief in the 3-year plan, the value that creates. That will create a company that is generating substantially higher cash flow than now under most scenarios, especially given the contracted floor. It creates a very strong, very significant copper bottom to the revenue and cash flow profile of this business. And it's for the manager to continue to deliver on the milestones on that 3-year plan to drive confidence in the business. We recognize that. We're confident we can. We think we've ticked off several milestones in the last 10, 12 months, but there's a lot more to do. And we're conscious that we do need to deliver that to deliver the value and confidence. Of course, the board is always reevaluating what else it could do. They are probably going to give us some more time to evaluate this, to achieve as much as we can. If the discount continues to persist, they may consider other things in due course. However, naturally moving towards the reinstatement of more substantial dividends, any excess cash flow in buybacks have all been talked about and announced here today. So hopefully that people can see the fundamentals of the business continue to improve as we execute on the 3-year plan. Buybacks and of course dividends and more substantial dividends getting closer are key. But I do think there's one other one, which is the revenue forecast outlook. If we get a recovery in the backdrop that's been a very strong headwind for revenue forecasts start to turn, I think that will significantly impact the discount, because the amount of NAV reduction caused by curves over the last 3 years is very significant. It's over 60p, and that's offset. Only being partially offset by the value we've created, but fortunately we have been able to offset that through the value created through new build and so on. But we do need to see those forecasts to stabilize and then ideally go back up as we expect forecasts to improve if utilization improves as well. So that's one question asked several times by different people. James, I might ask you this one if you'd like to take it. Grid outperformed revenue forecast. What is driving this outperformance versus industry models? Without giving away any commercial secrets.
Yeah, definitely. So there's probably 2 ways of looking at this. One is what are the curves assuming? So the curves, as the curve providers have often said back to us, it's hard to model something being done wrong. So when looking at a system and it's being run efficiently, it's hard to put in an assumption that models something not being done as you would expect it to. But what they do apply to the model is a reduction in achieved revenues. And so what's the forecast prices might imply trading opportunity. They've haircut those down and they start to unwind those haircuts over time. So as a starting point, there's perhaps been a slightly better performance on the skip side than what the curve providers are modeling. So that helps add to it a little bit. And then on the other side is what are we doing differently? So we have a mix in our portfolio of trading assets, BM trading assets, non-BM assets, a mix of different services. We've also got tolls in place, and the tolls were signed last year at attractive rates relative to where merchant levels were, so that's helped secure some of the revenue in the portfolio. And then also we've been doing little bits with our assets to demonstrate additional uses of them, which has driven outperformance versus the rest of the market, particularly in non-BM assets. So a combination of those two is why we're slightly ahead. This kind of hopefully more reasons to outperform the curve soon as some of the BM issues are resolved over the next 6 to 12 months as well.
Great. There's lots of other questions. So one of the questions, you've committed to a token dividend for regulatory reasons. Would you consider pausing dividends entirely to accelerate growth? I'll take that one quickly. We got feedback from a large percentage of our shareholder base ahead of the decision made by the board, and the conclusion was to obviously we need to pay the dividend that's driven by regulatory drivers in 25 relating to 24, and there may be a repeat of that to some degree in 25. I think the question is that it's in 26. The question is would we get rid of that 26 dividend? I suppose it equates to a little over £1 million. I don't think it will make a massive difference if we were to delete that altogether, but would cause some challenges for some shareholders that do need a dividend, however immaterial it is. So we try to strike a balance. We have focused on growth. We do think that the returns available in the market now are very attractive, and we do believe that it's important to scale this business as much as it does cause sometimes consternation in terms of the lack of dividends in the short term. So hopefully that helps a little bit. I'm happy to take any further follow-ups. There's another question here. Could the introduction of a capacity market reform providing additional revenue layer for grid? Very simply, potentially, but we're not aware of any reforms that will drive any upside to revenues. There is the introduction of what's called the long duration energy storage cap and floor regime, which will compensate 8-hour duration anything, batteries, pump storage, hydro, and other assets, with a guaranteed minimum real return for 25 years index linked. So this is something we're looking at very closely. The returns aren't spectacular, but they're certainly very interesting. And the cap is not a hard cap either. There is a 30% revenue share above the cap. So we're exploring this. The law is not formally in place and so on, but some of our projects have been rewarded with being eligible, especially our pipeline projects, and we look forward to participating if the numbers add up. So that is an opportunity.
On capacity market specifically, we have always perceived capacity market as undervaluing batteries. Batteries provide a vital role in the system, and particularly as we move towards a greater prevalence of renewables. So if there are reforms of capacity market, we'd hope they'd be fairly positive towards battery assets.
Thank you, James. Then beyond regulatory reforms, what other revenue streams or strategies are being pursued to diversify income? So we've got the 3-year plan is all about extracting better revenues from longer duration assets, augmentations. New pipeline also built to a minimum 2-hour duration, so benefiting from the most profitable spread available in terms of duration. But in addition to that, we had a three-pronged to our 3-year plan, and the third prong was alternative revenues. And we've been quite coy about talking about this for commercial reasons. But it's worth touching on this. Our batteries are earning, below £10 per megawatt per hour today, which is why we equate that to 75,000 in merchant terms per year. The wholesale price of electricity is at £100, so there's a lot of difference between less than 10 and 100, and we believe that through a particular trading strategy we can extract value from that upside from our current revenue rate all the way up to 100. We can't say how we're going to do this, but we do think that we are well progressed in our thinking on this, and look forward to executing on this, subject to various requirements that we've got to jump through to achieve that. But that's our main source of diversification away from the current regulatory backdrop, while also trying to drive the improvements in the regulatory backdrop that we've got. So I'll leave it there unless there are any follow-up questions. There's another question: is what happens when a bidder likes to buy a company? Well, like we've seen in Harmony and any other company that ever gets bid for, there'll be a process that needs to be followed. No doubt they'll be guided by their advisors and lawyers, but ultimately it's all about either making a hostile bid or a bid that's approved by the board. And so the likelihood is that a bidder would approach our board with an offer. If that offer is fantastic and the board wants to take it and recommends to shareholders to take it, then it's a straightforward picture, although some shareholders might not like it and hold out. Or it might be an offer that's not liked and the bidder might reconsider, offer a higher price, or at some point stop increasing it and try and potentially approach shareholders directly, and that becomes a hostile takeover, as the terminology goes. But if someone wants to buy this company, they're perfectly entitled to make a bid, and the board is there to receive bids if there are any. I'm conscious there's another question here. Do you see opportunities in hybrid projects combining BESS with solar or wind assets? In short, yes. It's not a super straightforward answer, because there's also it depends aspect to it. When projects are hybridized, you are effectively have the opportunity to store the power from the renewable generation, and you benefit from having better use of that connection as a result of having two technologies there. So the renewable can generate and sell straight into the market when the pricing is favorable, and when it's not, it could potentially store it in the battery for onward sale later. And of course, you're putting more through that connection, and therefore it's one connection for effectively what would normally be two projects, and so you're saving on that grid infrastructure. However, you do have to take a view on whether it's cheaper for a battery to buy power from the market, potentially at very low prices, versus buying it from itself at a price that is effectively needs to meet a hurdle rate. So that's something to be considered. But the degree to which that renewable asset is contracted, bearing in mind that solar and wind is typically benefiting from CFDs going forward, or can do, is another feature. So there's lots to weigh up, but we do see opportunities there. And really, in terms of physical diversification of our projects, you can extend the life, you can add batteries and extend the duration, you can add alternative forms of generation. And all of these are things that we're exploring. But of course, we've got a clear plan to focus on in the next couple of years. But over time, all these things are things that we're looking at. And indeed, the extension of life and acquisition of land on project is something we've already done. James, I don't know if you have anything to add to that, but hopefully that's useful. There's another one, which is, what do you expect slide 13, which is the competitive landscape slide, to look like in 3 years' time? How will significant expansion by others at low battery prices impact potential revenues? Very good question. Next one forward, please. Next slide. Thank you. There will be more capacity. The government is wanting the sector to expand to over 20 gigawatts from 6 today. We do see the need when we get to 70, 80+% renewable generation, which is going to happen in the next, let's say 5 to 10 years broadly, but 5 to 7, 8 is quite reasonable assumption. We do see a need for upwards of 30 gigawatts at a national level, when you start dealing with the fact that that national picture is complicated by bottlenecks in the network, and so you'll have to put extra batteries either side of bottlenecks. It means that actually the need is probably well over even 30 gigawatts. And as you get to the sorts of levels of renewable generation of 70, 80%, which can at any moment in time generate very close to zero, or as much as twice their expected 70, 80% level, average level, means that you could overgenerate or undergenerate for long periods. We actually see a fleet requirement of upwards of 30 gigawatts with an average duration of 12 hours, as a sort of a good sort of estimate today, before we look at the constraint issues or bottleneck issues. That's miles higher than where we are today. And it's miles higher because there's a lot more renewable capacity coming online over the next few years as well. It's not just batteries being built out, it's pretty much everything, and in particular offshore wind in terms of the largest numbers and chunks of energy or power. So in terms of competitive landscape though, so that hopefully addresses the fact that there's a need to build out very significantly. In terms of who our peers will be, we're aware of companies like Zenobē, like Statera, some of these that are not so much in this page, like CIP, Copenhagen Infrastructure Partners, a couple of the projects backed by the National Well Fund recently, so Equitix and Fidra Energy will build fairly large projects over the next 3, 4, 5 years. So we do expect several other 500 to gigawatt portfolios and potentially even upwards of gigawatt portfolios to start to emerge. But there will only be a small handful. And we do wonder whether there's enough funding to get the sector up to the levels wished for by the government without a significant improvement in skip rates. So that they will go hand in hand. Confidence in the sector will drive more investment. But of course, any investment will still be on a measured basis. The grid companies are overwhelmed with all sorts of new projects wishing to connect. There are 6,000 connections out there that have been issued for generation over the next 15 years. Of course, that will be reduced markedly, but there's a huge amount of work to do here to connect solar, wind, and batteries and other things as well. So there will be, to summarize, there will be 2 or 3 large competitors of gigawatt scale or larger. We'll continue to grow towards the 2 gigawatt level, and we will have ambitions beyond that. So it'll become much more concentrated. I'm not sure what will happen to the tail. And then they might hang around, but there will be a consolidation phase, I'm sure. That would be my speculation. And then one final question. We've just got one more. We've got a few minutes left, so I'll ask it. And James, if you want to jump in and have a go. What drove the reduction in 2031 revenue curve forecast? It seems oddly specific.
Sure. Apologies, I think in my mind fog from a cold, I probably didn't go into the detail in the 2030 onward section as I liked. So just reverting back to those slides, hopefully you can see them on the display. So from 2030 onwards, so it's not quite 2031, it's probably 2030 is where the reduction comes in. That longer term tail of the forecast comes from various sources, but essentially underpinning an asset mix that's expected longer term. And that uses things like the future energy scenarios from NESO. The curve providers use that as a basis for what's expected at key dates. So often they refer to 2030 and 2040, sometimes 2035, of what generation mix is expected at those timescales. So at 2030, there's been revisions in the latest future energy scenarios. Thankfully, there is more batteries expected this time around. It's been a fight for a little while, so they're starting to recognize that. But what we're also seeing in there is various technologies that either we don't think are going to be built to the scale that they've put in there, or just aren't going to be on the system because of inefficiency and things like that. So we are seeing a lot of CCUS still in those numbers. So that's gas with carbon capture, and also pump storage. The reason for the large kind of pump storage in the model at the moment was primarily driven through LDES. So there's an expectation that pump storage would have gained a lot of contracts in the long duration energy storage process that's running at the moment. We understand now that a lot of pump storage is pulled out, and it's a large part is lithium-ion batteries. So what we're building ourselves is driving most of LDES now. So the expectation of that volume of pump storage is likely to go away fairly soon. As for the carbon capture and gas, we believe as you get closer and closer, the inefficiency and the cost of all of that will prohibit it being built. So as you get closer to that timescale, you'll start to see that unwinding even further. So at the moment, the curves assume quite a large build out of other stuff at 2030, which we just don't see happening, which has effectively created a bit of a swamped market from 2030 for a period, and then it starts to tail back up as the model moves to an efficiency metric. So the assets that get built out are the ones that are price effective and therefore make a return from the opportunity that's in there. Those that don't get built out are the ones that can't make the return from there. So you start to see more batteries built out in the model from that perspective and less of the other technologies. So that's why you start to see it tail up from those key dates.
Okay, very comprehensive.
That's great, Ben. James, thank you very much indeed. There is one question from Bruce who asks how to access the slides and the recording. Bruce will send you a link to access both from your dashboard. Ben, James, thank you once again for your time. I know investor feedback will be particularly important to you both, and I'll shortly redirect the attendees on today's call to give you their thoughts and expectations. But before doing so, Ben, if I may just come back to you for a couple of closing comments.
Yes, no, just thank you very much. You can also access the interim report and accounts on our website and also on the London Stock Exchange website. So if you want to review the longer form document, please feel free to reference it there in either of those places. Otherwise, thank you very much. We look forward to communicating further progress on our 3-year plan and other developments in the industry as they emerge. But for the time being, thank you very much for joining us today.
That's great, Ben. James, thanks once again for updating investors. If I could please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This may take a few moments to complete, but I'm sure it'll be greatly valued by the management team. On behalf of Gresham House Energy Storage Fund PLC, we'd like to thank you for attending today's presentation and wish you all a good rest of your day.